So today we're going to be talking about financial statement analysis. So for many people in this class, the idea of accounting might have been very interesting, and for some it might have been frustrating and you're more interested in finance. And I want to stress to you that if you are interested in going to finance, accounting is the fundamental language behind it. So this class will take you leaps and bounds into your future financial career, no matter which way you head, if you decide not to go into a pure accounting career. So what's the purpose of financial analysis or financial statement analysis? And so we want to be able to reduce our uncertainty, apply analytical tools, and we want to be using all the data we're able to receive from companies. And so who can use this? We can use it as management of a company or investors in the company or creditors. So internal or external users can use this information. And so what I'm going to be talking to you about today is actually quite interesting work. So if you're invested in ever retiring with stocks, using stocks to make money, buying other companies, or using comparisons for investments, investing in real estate, really any investment at all today is going to be covered through financial analysis. So we're going to be going through everything we learned in accounting and then how to make those comparisons in order to be able to make wise financial decisions, either in the stock market, as a management of a company with divisions, if we should cut them or keep them or expand with them, or just through everyday life. So mainly this will be accounting focused, where we're going to be focused on company analysis, but you can use this really with any kind of financial analysis, even with your own personal budgeting. So information used for analysis, generally the information we're going to use is purely the information generated from accountants, right? We're going to use our income statement, balance sheet, statement of stockholders' equity, the cash flows, and the notes to the financial statements, which is everything we've talked about how to prepare earlier in this class. So that's why it's so important to understand accounting, is so we know how the information was developed, so then we can assess it if you're in finance. Obviously, accounting can get more complex. This class is enough where then if you did financial analysis, I would be confident that if you understood everything in this class, you would be able to understand at least where the information is being derived from for financial statement analysis. So when we're assessing companies, there's really a few ways we can assess them using all of this information. We can assess company intra-company, which means we can assess divisions within a company. Like if I'm Procter & Gamble, I might have a body wash division, I might have a food division, and I might want to compare the division's profitability. So that's intra-company, comparing within. Or if I'm a consulting company, I might want to check my tax division and my financial accounting division and see which is more profitable. That's intra-company. We might want to check against our competitors. If I am running my consulting firm, I might want to see if my competitors are making as much margin as me, or if they have as much fixed expenses as me, or they have as much marketing expense as me. This all ties into a comprehensive business knowledge and business acumen, right? Competitive analysis. I also might be interested in their pricing, right? And how their sales are working. Is their sales growing more than me? Are they getting more market share? I might want to compare against the industry as a whole using industry reports. So I might, it would be useful for me to understand as a whole, are my rates too high? Are my rates too low? Am I on track? If the industry is growing and my business is shrinking, what am I doing wrong? If I'm exceeding the industry, what am I doing right? And we might want to also compare against just general guidelines. So guidelines might be industry best practices on if you charge a billable rate, maybe we know you shouldn't charge over 100%. Or a better example is food industry, right? So staying relevant to what's in the news. A lot of companies right now are being penalized for food gouging or price gouging for food, for products, for toilet paper, all of that. And it's because they've gone beyond the federal guidelines. There are certain guidelines that everyone expects to be reasonable. And once you start charging 10 times as much for sanitizer, then you either might break a law, or you might or you violate internal guidelines for people, right? Where they you offend people and you can lose business. And so making sure that we're using this information to assess all of these as management, to assess our competitors, assess against the industry, assess against what could be legal guidelines or just moral guidelines. And so how do we assess? There's really three main tools we can use: horizontal analysis, vertical analysis, and ratio analysis. Horizontal analysis, we're just seeing one company and we're comparing to our performance over time. And so the value of this is seeing if our revenue is going up over time, if our expenses are going down over time, and we're seeing the percent change over time. And then we can compare that percent change potentially to other companies, right? So we're always finding a percent change so we can compare to other companies. The reason for this is if I'm a consulting firm and I make $1 million a year, but I want to compare it to a company that makes $1 billion a year, I can't do that with numbers, right? That their business is so much larger. But what I can do is compare it with percentages. And so we'll go over why that makes sense for how we can compare best practices and make sure our companies are on track. So that's comparing a company's financial condition over time is the horizontal analysis. Vertical analysis is comparing it as a percentage against a percent of base amount. So marketing departments generally do this. It's not a best practice for marketing, but for marketing departments might say you are allowed to have no more than 10% of total sales in marketing budget. And so that's comparing a financial condition to a base amount. So we might look at Apple and Microsoft and determine who spends more on advertising or marketing or selling expenses. And we can see who has a more aggressive sales strategy. Or if it's our own company, we can determine if we're spending enough or too little on marketing and selling expenses. So we'd be comparing it not over time, but as a percentage of a larger bucket. And then ratio analysis. So there's these key ratios, and this will be what the majority of this section of the final will be on, is memorizing your ratios. And so these are measuring key relationships between financial statement line items in order to make comparisons with other companies. And so this is stuff like quick ratio that we're going to talk about today, acid test ratio. But what most people would think about as most common is price earnings ratio or profit margin, profit ratio. So, or profitability. So that's taking these key terms, these key formulas that everyone knows how to calculate after they've taken, their college business education, and then using them to compare against other companies in order to determine key factors being liquidity, solvency, profitability, and so forth, which we're going to go over in detail today. So these are our three tools, right? Horizontal, we're looking across time. Vertical, we're comparing against a larger bucket, either total sales or total expenses, revenue, net sales, and looking at individual line items against that bucket. And then ratio, looking at key indicators of a business. What we can also think of as almost a management dashboard. We aren't doing a group project here, so we're going to skip that. So horizontal analysis refers to across time. So we're going to calculate that change as a percentage. And so this is just going to require some basic algebra. But what we'll have to do is take a dollar change over a base period amount and multiply it by 100. And so what we have to be careful with here is what is the base period? And the base period will always be the prior period. So if we're trying to compare 2020 numbers, we'll be looking at 2019 as our base period. And so we can go over the calculation here. I'll take out my calculator. So what if we wanted to see how cash changed over the year, right? That's a useful metric. Did we gain more cash or did we lose cash? First thing to be careful with is always be careful with the dates. Financial statements normally put the most recent date on the left. And I think it's very common for most people to read as sequential, where the latest comes to the right. So just be careful here, where 2018 here is on the left. Companies can present either way, but most common presentation is most recent year on the left. So 12,000 minus 23,500. That's an $11,500 difference. So the question here, this is useful information to us because as management, we know that our cash dropped. And where would we see all the changes related to that cost drop? We'd see that in the statement of cash flows, which we covered last class. But the question here is, how can I compare it to a company who maybe has $10 million in cash? Well, what we do is we take the percent change. So we take the 11,500, and then we'd have to divide it by the base period. And so my question in class here is then, what is the base period? Perfect, Sunil. 2017. So we'll take it divide it by the 23,500, and we get a 48.9% change. a drop. When it's in brackets, that means a decrease. So this is a percentage. We can make it more of a true percentage amount by just multiplying that by 100. So this is 48.9%, 48.9% decrease in cash. And now we can see, based against other companies, how much their cash has increased or decreased and make comparisons. Generally, we'll do this for every single financial statement line item. If you ever become a financial analyst, you do this for every line item and then compare to your competitors, compare intercompany, compare pretty much everywhere you can to understand how you're doing compared to the market and how you can improve. And so, again, we can pretty much automate this, but the 520 minus 480, we know dollars increased by 40,000, and we divide it by the base period to get our 8.3% increase in revenue. And we can continue to do that down here to see all of the changes that occurred in each financial statement line item. So from this made up company, right, we can see that revenues increased by 8.3%. That's useful information. We know that we're selling more. How did we sell more? Well, our costs increased by 14.3%. Our cost of sales. So our profit margin has actually decreased because our cost of sales outpaced our revenues. That's a problem. We also, to increase the revenues, increased our selling and administrative expense by 2.1%. This is for internal management. Our interest expense over time decreased, which means we paid off some of our debt, which is good, and could be potentially good. And our net income, despite our revenue increasing, our net income decreased by 21.9% because of these cost of sales, increases in cost of sales and selling administrative expense. And so then we can compare these market averages to other companies to see if we're on track. So to reiterate, which bucket does this fall into? Is this horizontal analysis? Is this vertical analysis? Or is this ratio analysis? Just make sure you're all paying attention. Perfect. And why is it horizontal analysis? Yep, time. Perfect. We're measuring the company over a period of time. And so during the final, right, I'll be exactly comparing horizontally to other years. That's another way to think of it. And so what I would recommend is just practice some of these calculations, because I'll be asking you to calculate percentages on your final, right? And then and asking you to memorize some of the ratios here. So practice these comparisons and then try to understand what it means. So I can go through these calculations, but I think that they're relatively simple, and I'm sure everyone is more interested on what's going to be on the final. So I'm not going to stick here too long, but we'll go play with some companies so we can make some comparisons soon. We'll spend a little time doing that today as well. So here's another example where we took the revenues, took the difference, dollar change, and we can see how the percentages changed. So vertical analysis, then, we've talked about over time, and I think that everyone here can see how that's useful, even from a personal budget standpoint. If I can tell myself, wow, I spent $10,000 on groceries last year, but $30,000 this year, just from a management perspective, that's useful to know, right? That, oh, wow, my bills increased 20,000. What happened? Is it because coronavirus and the market went up, or is it because I started eating out less? And so we can look at our personal budget from that perspective, and companies do the same thing. But then I might go to my friends and say, well, hey, did you spend an extra 200% on groceries this year? And they might all agree, or they might say that I really wasted my money. And so that's where companies are just doing the exact same thing, right? They're making those comparisons to make sure that they're on track with the norm, and hopefully doing better than the norm. But the next thing we can do is take vertical analysis. So vertical analysis, we're just taking the financial statement line items and comparing them to large groups, normally percentage of sales or percentage of assets. And so what are some normal comparisons, right? So I might want to compare my marketing expense to sales. I might want to compare my profitability to my sales. Or for my assets, I might want to compare my liabilities to my assets, right? See if I have enough assets to cover my liabilities. Enough current assets to cover my current liabilities, or break it out in different portions like that, right? So we should always have enough assets to cover our liabilities, or else something's off in our financial statements, right? Assets equals liabilities plus equity. So, so vertical analysis, we're going to do the same kind of ratio. I'm not going to go over the math here, other than in an example. So on balance sheet, normally we're comparing to total assets, and then income statement, we're comparing to revenue or net sales. And so revenue, we're going to compare to total revenue. So we're not, even though we have multiple periods here, we're going to compare against the current year, right? That's the whole change in vertical analysis. We're not comparing the change over the year, we're comparing the current year. So 520,000 divided by 520,000, we're always comparing against the revenue, is 100%. So out of that 520,000, how much did we spend on cost of sales? We just take the 360 divided by 520. That gets us our 69.2% here. And then for 2017, 315 divided by 480, that gets us our 65.6% here. And so this is useful, right? Because as our revenues increase, it might be difficult to see and compare how much our sales mix changed, or our cost mix changed. And so here we can see we actually spent more as a percentage of cost of sales on the revenue this year. And maybe that's because direct materials went up. That's maybe because we had to pay more for labor. But then we can go investigate that and see if there's anything we can do to control this cost. Right? Companies make money by generating revenue and by controlling their costs. Selling admin, that's 24.7%, instead of 26.3%. So again, that comparison was just done by 128,600 here, divided by 520 to get the 24.7%. We can keep doing that math, but I think it's relatively simple for the team. So 128,600 divided by here, we see that over the year, when compared to revenue, we're actually spending less on selling an administrative expense. And maybe that's a good thing, maybe that's a bad thing. Maybe if we spent more, we could have got more sales, but we can go investigate that and compare to other companies. And then we've decreased our interest expense. So we'll continue to do that. And then ultimately, we see that we've made 17,500 divided by 520, 3.4% of our net income from these revenues. And so this would be a little concerning, that even though our revenues increased, our net income dropped. And why did that occur? It looks like the majority of that occurred because of the increase in the cost of sales. And so then we could go investigate. Generally, we don't want to make more sales and make less net income, right? So we can go investigate that matter. And we can see that clearly, that our net income as a percentage of sales dropped by 0.6%, which is not what a company wants. So we can continue to do these assessments for revenue. You could also do it for assets as well, which we'll go into very specific examples for assets down the road. But for assets, we're more concerned with liabilities. As a percentage of liabilities of assets, are we able to pay our liabilities in a timely way? So any questions about vertical and horizontal analysis before I go forward? Doesn't look like it. Feel free to ask questions while I continue to go. So building blocks, so there's three pieces here, right? We have horizontal, vertical, and ratio analysis. And we'll put this all together and we'll do a live kind of case study together very shortly. So the ratio analysis, this third piece, we're really trying to measure these key buckets. And I'm expecting you to know these four key buckets. It's essential to your business education, knowing this terminology, and you will be tested on it. So not just in my class, probably the rest of your education. First, we want to know liquidity and efficiency. So what is our ability to meet short-term obligations and to efficiently generate revenues? So that the goal there is anything short-term, a year or less generally, how are we going to be able to meet those goals? It doesn't matter. It doesn't matter at all if we have enough, if we expect to generate enough money in 10 years to pay our long-term goals and get rich, if we can't pay our debts today. And that's a problem we're seeing, right? This is very relevant in today's market with a lot of the restaurant industry, where maybe these companies on a long-term basis are expecting to be extremely profitable, like Soup Plantation. But if they can't meet their obligations in the next year because no money is coming in, they'll go out of business, right? So even though they have a long-term solvency, you could be illiquid in the current year because they have all of their money tied up in investments. From a personal example, that could be someone you know who's house rich and cash poor, right? So if you don't have any money, even though you currently available, even though you have $300,000 or $400,000 into a house that you have a mortgage on, but if you lose your job and are unable to pay for that mortgage, you have no liquidity, even though you might have solvency. So liquidity, we're talking about these short-term obligations. Are we able to satisfy them? We'll go into that. Normally looking at short-term liabilities versus short-term assets or cash. Okay, question. Do horizontal and vertical analysis intercompany analysis tools, or can we use them for competitors analysis? We use them for both. We use them internally. We can compare them against divisions in our own company. You can. I use the example personally, right? We can compare. We can compare how we're doing if you have multiple jobs, how one job's paying you versus the hours you work versus another company's paying you. So you can use them for your own yourself, your company, inside the company. You can look at it inside your company over time on a large basis. And then you can look at it from a competitor analysis as well too. So you can look all of these tools. You can use a competitive analysis, benchmark analysis, internal analysis. So liquidity. Good question. Good question. So liquidity is we're really talking about that short-term obligation, and we're seeing a lot of that in the news today, right? Solvency is that ability to generate future revenues and meet long-term obligations. And so this is talking about in the long run, can my company am I going to be able to pay off my long-term debt? So this is what bankers look at if you're looking to get a mortgage on your house, or if you take a $400,000 loan for your townhome or your condo in the Bay Area, will you be able to pay that off in 30 years? That's a solvency equation. The liquidity is, will you be able to pay it off in the next month? Oh, maybe you have enough cash to pay it off in the next month, but will you be able to make those payments over the next 30 years is a solvency question. So solvency is those long-term goals, anything over a year. Liquidity is short-term. And companies can be either or both, right? You could be illiquid but solvent. And the perfect example there is the restaurant industry now. We can't meet our obligations today, but if we were to stay in business 5 years from now, we could probably meet all of our obligations. Well, that doesn't matter. If you can't pay your obligations today, you probably have to declare bankruptcy. You can be liquid, but insolvent. So I could develop a business model and have $1 million in the business. And this is very common from a personal standpoint, right? I see this a lot with small businesses where people go and invest $100,000 in a business that doesn't have a lot of potential. And sure, maybe they only owe $30,000 or $40,000 a year, so their company is liquid. They can pay it off in the next year, but it's not solvent, right? If you look and forecast their cash flows over the next 5 years, there's no way that they're going to be able to meet the long-term obligation. Maybe they owe a debt in 5 or 10 years that there's just absolutely no way they're going to meet. They're not solvent. That would also be a cause for potential bankruptcy or to leave a business. Or you could be both liquid and solvent, which is ideal. And that's how a business can move forward. If any of these are an issue, you need to fix it quick. Liquidity, you normally need to fix it through getting loans. You need to fix it through raising capital through investments. Or finding some, if you're illiquid but solvent, you need to find a way to raise capital in order to save yourself over the next year. And a lot of companies do this through a lot of different banking agencies like Silicon Valley Bank, Wells Fargo, or they try to raise rounds of investment, right? And that's where you hear like investment banking coming in and investors coming in. Solvency, if you're insolvent but liquid, you need to fix your business, right? So you have enough money to run the next few years, but you can't pay off your long-term obligations. There's something wrong with your business model, and that's normally an even more difficult fix. And if you are both liquid and solvent, then your business can operate as normal. What ties into all of this is profitability, right? And so all of these are separate metrics that we want to assess. Profitability, is the company able to provide financial rewards sufficient to attract and retain financing? And so it doesn't matter at all if I'm liquid and solvent if I'm not making profit, right? So I know, okay, I can pay my obligations to my short-term creditors. I can pay it to my long-term creditors, but let's say I'm not profitable. So I'm going to try to use an example in industry that you can think about for each one of these. So liquidity, we talked about the restaurant industry and why they're going bankrupt. Solvency, or many are going bankrupt. Solvency, better example are construction companies, right? If we have in the Bay Area a lot of companies building apartments, and so those companies receive lots of money from banks, tens of millions, hundreds of millions of dollars to build these apartments and then hopefully sell them for a markup. And so these companies will be liquid, but or potentially not solvent if the value of the building goes down. So if those buildings are worth less than the mortgage that they've taken out or the loans from the bank, the company is no longer solvent because they would never be able to pay off those loans. Same thing would happen if you purchased a home and then the home value decreased below your mortgage value, which happened in the previous recession. That'd be a solvency issue that you could never make up for the fact that you owe more than the thing is worth. That happens to a lot of people who take car loans, right? Where you might buy a car that has a $25,000 loan, but if you resell the car, the car would only be worth $15,000. That $10,000 difference is a solvency issue. You might be able to pay for it within the next year, but from a solvency, if you sold the car, you would still lose money on it. That's a solvency issue. Profitability, that's where how is the company generating the money from able to generate money and profits in excess of its costs. And so a good example of this is from like a consulting perspective. One of the reasons I enjoy consulting is it's an extremely profitable business, right? So if there's normally very low costs, especially if you don't have an office, and tutoring is a great example of practicing consulting. If you're in college, I highly recommend it if you're looking for work. Anytime tutoring can pay $20 to $50 an hour, then it's a good example to kind of get your foot into running a small business. Beside the point, profitability, consulting businesses are generally very easy to be profitable, especially if they're run by yourself, because you have very low costs. And so if you're making $50 an hour and it only costs you $10 an hour in supplies and travel, you're making a profit of $40 an hour. That's high profitability. And if you're able to improve that, you can potentially receive financing from banks and investors who want a piece of that cut as you expand your business. But other companies are very low profitable or are not profitable. And that's in the Bay Area where we're having a lot of issues right now, and why financing is pulling out of the Bay Area is there's a lot of extra money going on trying to get companies to be profitable. You might have heard this with WeWork or SoftBank transactions if you're paying attention to the news. But these companies were, even though they had tons of cash investment, they're liquid and solvent, they had no near future profitability, where they were losing money because their products just weren't interesting to investors. They were paying a lot of money on engineers in order to develop these products, or these products weren't available to customers or interesting to customers. So it doesn't matter if you have the money if you can't make a profit, right? And so that's one of my rules I've said for business right at the beginning is you really don't have a business in my mind unless you're in pharmacies or something, life sciences, very niche business. But most business people, until you have your first sale and you're making a profit, I would say that you're not truly running a true business. And so always focus on profitability, and we'll have metrics to compare profitability across industries. It's very different, right? As you can imagine, grocery stores or coffee stores might have very low profit margins. But then something like consulting might have higher, or software have significantly higher profit margins. It just depends on if it's a commodity, if it's a luxury good, if it's a premium service, and you're going to learn about how all that ties in your economics classes and marketing classes. But this is just a high level overview. And then the last piece we're going to be talking about from a ratio analysis assessment is market prospects. So market prospects is the ability to generate positive market expectations. And so that's going to be market prospects. If I'm a consulting company, can I charge a rate lower than my competitors? Can I offer them something that they don't have? And we'll go over, there's just a few ratios we can go over that can talk about market prospects. We also might be interested in things like market share. We're going to learn this more in marketing and economics. If in the consulting industry, I'm just using this as an example because I'm in it. In the consulting industry, if I know the total market share, or the total potential market is $1 billion in the Bay Area, and there's only $100,000 being spent in the Bay Area on consulting, I know that is a very useful metric for me to enter into this market because of the market prospect. But let's say there's $100 million in the Bay Area of market share and $100 million being sold. The only way for me to win business is to fight off competitors. And so that lowers my market prospects. And so it's a harder to generate a positive market expectation. We can see that against guidelines and business analysis and competitive analysis. So I ignore the highlights. I want you to memorize all of these. This is all important: liquidity and efficiency ratios. All of the ratios that I talk about today, I expect you to memorize. Memorize for the exam. They're not too complex, but you need to know them. They're extremely useful. And so just flashcard all of these. So all of these are going to be focused on, we're going to be focused on one of each of these buckets: liquidity, solvency, profitability, and market prospects. So liquidity ratios, we want to know about working capital, current ratio, and the acid test ratio. These are key to know, some of the most important to know about businesses. So working capital represents current assets financed from long-term capital sources. So what we're looking for is how much money do we have today to play with? That's the fun way to think of it. How much money do we have today to spend on in current investments? And so all we're going to do, and this is just memorizing the formula, is 65,000 current assets minus current liabilities is going to equal our working capital. That's it. That's our working capital assessment. And so where this might be confusing for you is on your exams or in real life, when you're doing this assessment, is these might not be given. Current assets and current liabilities might not be given. And so you would have to know that cash, accounts receivable are all parts of current assets, inventory, and then accounts payable and current notes or current portions of notes or short-term notes are part of current liabilities, and recalculate these amounts. The more working capital we have suggests strong liquidity, right? Meaning we can afford to pay off our debt, our short-term debt. We can be in business for the next year. We're not going to have a problem. We have some cash. The way that we compare this to other companies is through the current ratio. And so this working capital is just to determine the dollars of working capital, the money we have to play with in the year, in excess of what we expect to owe. So the current ratio is how we compare it to other companies. So say an example, but instead of us subtracting it, we'll divide. So we take the current assets over the current liabilities, and we'll determine how much, what is our ratio. So memorize this. What is our ratio of current assets to current liabilities? Anything over one or over means that we're liquid. Anything under 1 means we're illiquid, and we need to find some cash quickly, because we're not able to satisfy our current liabilities and we'll be in trouble and have risk of bankruptcy. The higher this is, the better, generally, because we're able to determine we're going to be able to be more liquid. And so then we can compare the current ratio to our competitors to see how well we're doing. Remember, a lot of companies try to do well with their cash management. So the higher it is, the better it is for liquidity, but maybe not for profitability. Because if we have a lot of current assets, like a lot of cash that we aren't using to expand our business, it could be troublesome. It could mean that we're not using our capital wisely as investments. So that's why companies aren't always sitting on a lot of cash. They're reinvesting in their business or external investments. So there's a risk here, right? Current assets include a few pieces that are really difficult to say that we'll collect cash on. And so a lot of investors don't like including those pieces in liquidity analysis, especially bankers, right? So they use something called an acid test ratio instead. The main piece here is we're excluding inventory from this test. So because a lot of companies say, well, if let's say the coronavirus is a great example right now, where people just don't want to go buy your inventory. It doesn't matter that you have $1 million in inventory. If no one's going to buy it and you can't sell it, are you going to be able to convert it into cash? And so, and financial analysts came up with the acid test ratio, which is anything that can be convertible into cash relatively quickly, very, very quickly, and is almost certain, then we're going to use that to determine our liquidity. And so what we're going to use for the acid test ratio is just cash, short-term investments, and current receivables. So these are pieces that we expect to turn into cash with no problem at all. And then we'll divide it by our current liabilities. So this is different where we're excluding inventories. And also you'll notice we're excluding prepaid expenses, right? Because that would be difficult to get refunds on. If you prepaid your insurance for a year and you needed the money back, likely the insurance company is going to give you a hard time. And so really the point of the acid test is it's a more stringent requirement in order to determine if the company's liquid. So I expect you to memorize the working capital calculation, the current ratio calculation, and the acid test. All different ways. Working capital, again, is a way to see how much cash we have left over to play with in excess of our current liabilities. Current ratio is so we can compare our current assets and current liabilities. Anything over 1 is good. Anything under 1 is bad, means risk of bankruptcy. An acid test is a more stringent requirement in order to make sure that we can meet these requirements, meet the short-term liabilities. And so here's a perfect example where I could just ask you to calculate each one of the ratios. So I could say, for this, please calculate your working capital, please calculate the current ratio, or please calculate the acid test. And so to calculate the current ratio here for 2017, we're taking the 31,800 plus 89,500 plus 11,500 plus 10,700. But we're going to exclude the plant assets, because plant assets are long-term, right? And then we'll divide it by our current liabilities. What are our current liabilities here? Just the accounts payable. And that gets us our 1.88. All of these other ones are long-term, so they have to deal with solvency, not liquidity. We have a question. So this current receivable and acid test ratio includes the current amount of notes receivable. Yeah, current receivable, yes, it would include the current amount of notes receivable as well. Good question. The answer there is yes. Anything we're expecting to receive within the year, that's almost certain to be, almost guaranteed to be cash. So how would this compare to the acid test ratio? Acid test, we would exclude the inventory and prepaid expenses. And so you can see here if the company might be liquid in 2017 from a current ratio, but then illiquid from an acid test ratio. Where let's say their merchandise inventory and prepaid expenses couldn't become cash. Let's say they had trouble selling it or it was out of date, then this company would be in trouble, which is why we need both of these ratios to compare. And that acid test ratio, we just take the 31,800 plus the 89,500 and divide it by the 129,900. The other risk here is too, we're seeing the ratios go down, right? So that was vertical analysis or ratio analysis. Then we can look horizontal analysis that these ratios are going down. So the company is having some cash problems, some liquidity problems as their money gets tighter. And that's something we'd want to investigate. As a company, you're required to tell investors if there's a likelihood that you might go bankrupt in the next year. And that's called a going concern assessment. So if you ever see that language on a financial statement that the company is worried about its going concern considerations, right? Going concern means that we think the company will last forever. If we're saying that the company is concerned about their going concern, then it means that they might not last the year. And so you'll probably see a lot of that on financial statements coming out over the next year. So those are those three pieces, right? Know your working capital, your acid test, and your quick ratio. I'm not going to be worried about day sales, but I'm going to talk about it today just so you're all aware. I want you to know about inventory too. And so the question is, how quickly do we sell our inventory? So the way we can measure that is just dividing our cost of goods sold by our average inventory, because that tells us how often we sold our inventory in a period. Very useful, easy way to determine it. So the hard thing here is cost of goods sold will always be given to you, but just determining our average inventory, we'll just take our beginning inventory and our ending inventory and divide it by 2. In this example, they're just taking the 10,000 plus 12,000 divided by 2, and then you take your 140,000 cost of goods sold divided by that amount, which was 11,000, to get your 12.73 times, which means that they sold their inventory that they had about 12.73 times. It tells us how quickly the turnover is. That could be useful if we're comparing Walmart to Target. and see, well, the higher this is, it means that the company's managing its inventory very well. It's not holding on to a lot of inventory. It's turning it over very quickly. If we see low inventory turnover, we'd expect that with bigger equipment, like cars might have a longer turnover time. And we can compare companies. Ones who have higher turnover means that they're able to sell the goods they have more quickly, which generally means that they're managing their inventory stronger. So just better inventory management. These last pieces are day sales uncollected, or day sales collected, or days in ending inventory. This just helps us know how long it takes us to collect our receivables. So this is a useful metric to see if we need to improve on the collection side of our business. And so what we do here is we take our accounts receivable net divided by our net sales and multiplied by the number of days in a year. So let's say we had 20,000 accounts receivable at the end of the year. We had $494,000 in sales, right? Multiply that by 365 days, and we get about 14.8 days. It means that it takes about 14, 15 days for us to collect on our accounts receivable, which is generally good. Anything over under a month is generally considered good days sales uncollected. Anything over a month is generally seen as needing improvement. We can do the same thing with day sales and ending inventory as well. Just take your ending inventory divided by cost of goods sold, multiply by 365, and that tells us how long our inventory is sitting on the shelves. Remember, it's expensive to keep inventory on the shelves. We have to pay for the warehousing costs, we have to pay for the storefront costs, and so we want to shrink this as much as we can. All of these are liquidity ratios. Everything that's not, everything that's highlighted here, like inventory turnover, your quick ratio, your acid test ratio, your working capital, I expect you to memorize those formulas for your exam. But understand, these are all different ways we can see how quickly the business can obtain cash. Is there any question related to liquidity that I can go over? Is this all making sense? Okay. Good, good. Good. Glad. This is a lot of fun, right? We can use this to make some interesting investments, and I'm excited to spend a little time today just on how we can do these comparisons. This is how I've made stock investments using these ratios that has very much exceeded, when I've had the time to do it, they very much exceed the performance of most stock indexes, right? And so using this, you can really see, understand the nuts and bolts of the company. Let's talk about solvency ratios. So we talked about short-term debt, right? So end of the day, can I pay my credit card bills? Can I pay my mortgage this year? Then long-term, can I pay my mortgage in the long term? Can I pay my student loans? All those questions are more of solvency questions from a personal perspective. From a company perspective, we talked about the construction company, right? It doesn't matter if the construction company can pay their current bills if they owe $1 billion and they can only sell their buildings for 500 million, which is what happened in the last recession, which that collapsed the economy, right? Is these companies were no longer solvent, and then the banks had to eat the price, and then eventually we all had to eat it through taxes. So solvency ratios. What we're going to be focused mainly is debt ratio and equity ratio. I want us to learn these other two as well, debt to equity and times interest earned. So we're going to use these numbers, but you can just go back to them for examples. So the debt and equity ratios. The debt ratio expresses total liabilities as a percent of assets, and the equity ratio expresses total equity as a percent of assets. Relatively easy, so straightforward, right? Hopefully easy to remember. Debt ratio is just total debt to assets. Equity is total equity to assets. So total liabilities, and then debt to equity is total liabilities over total equity. And so this measures how much of the assets is going to be owed pretty much by the investors. So the larger the debt to equity is, the worse it is, theoretically, right? a lot of people think of it as worse for small business. Know, though, that some companies, like in this marketplace, when debt goes down, sometimes you want a higher debt to equity ratio because equity might be more expensive. Bringing on a partner might be more expensive than taking a 1 or 2% loan. So here we go. Total liabilities, total equity, total liabilities and equity. So the debt ratio is just this 112,000 divided by 346,390. Gets our 32.3%. This debt ratio is just telling us that for all of our assets, 32% of those assets are financed by debt through an external creditor. Then we can find that 302,304, 390 divided by the 346, 390. 67.7% of this is financed by equity. So investors, right? So 32% is financed by banks. You can think about it, creditors, someone given a loan, and the rest is financed by investors. It could be you if you're a sole investor or a bunch of shareholders. Depends, and this will be more in your finance, if debt is more expensive or equity is more expensive. If you're a sole owner, you generally want to have as much equity as you can. If you're multiple owners, it might make more sense. You don't want the other owners to have as much. It might make more sense to bring on debt. And this tells us how quickly, how solvent we are as a company. If the creditors have more than the investors, then the creditors might be able to declare bankruptcy, say, we need your business, right? So that's a risk there. And then that debt to equity ratio, this is going to tell us how that mix is. Do we have more liabilities or do we have more equity? And you can see how companies are financed. Generally, companies are financed with more equity, right? You generally want to have more equity than debt. So you'd want this to be over 1. And then times interest earned. This is going to tell us how much income we have before interest and expenses over interest expense. And so this is where, from a personal finance perspective, right? If you're spending more on interest than you make, then you're in trouble, right? And same thing with companies. So we're going to take income before interest and taxes. We'll take the net income plus interest expense plus income taxes equals income before interest and taxes. Oh, this isn't. Oh yeah, we take our net income and we add back interest expense and income taxes. That's what we're trying to say here. And then, so we're saying total income and then divide it by our interest expense. So how much are we paying as a percent of interest? So we might say, let's say I'm making $100,000 a year take home. That'd be nice, right? That's a good amount of money. But what if my interest expense is 50,000? Then so I take 100,000. You'd add back in your interest expense, divide it by the 50,000. And so that's how I'd get my 100. I'd get a 3 times interest earned. So it means every year I make 3 times what my interest cost me or my interest expense was. Same thing, a company could do this. If you get less than 1, your company is in significant trouble. It means you can't afford your interest payments. Same thing personally. You could do this with your personal finances. And if your interest expense is higher than your income, you're probably in financial jeopardy, and you would need to work with a debt consolidator at that point. So that's solvency. So we talked about liquidity, we talked about solvency, and then the last ticket here is profitability. We're going to be mainly focused on is profit margin and gross margin ratios. But I want us to also know all of the returns as well. Return on total assets, on equity, book value per common share, and basic earnings per share. All this is useful for investors, especially the earnings per share. So expect all of it, but make sure you know the gross margins are probably the easiest. So profitability, we want to compare our company to other companies to determine how profitable we are in comparison. Again, all these is memorization. Profit margin percentage, we're just going to take our net income over sales. So in this example, we had net income of 53,690. Our total sales is 494. And so we can see our profit margin is 10.87. And so let's do this on some companies. So Costco stock. Costco's probably doing pretty well. And then Walmart stock. And so in these cases, we'd go to Edgar Online, SEC, company search pages. We went over this a few times, right? Walmart. You can go to their most recent 10K. And then we can go to Costco. Cost. We go to their most recent 10K. Which looks like it was. Here we go. So I'm showing you how we can do these comparisons if you wanted to make investments. I think this will be useful for you all. Costco 10K. So we have Costco on the left, Walmart on the right. We'll go to their financial statements. We'll just want to get to their balance sheet, right? Balance sheet, we're comparing liquidity and solvency. And then income statement, we're going to compare profitability. So let's get to statements here. Similar businesses, I think we could argue Walmart and Costco sell similar things, or they're resellers, right? We can compare sales. We can compare liquidity and solvency. Let's compare profitability for now. And so here's our statement of comprehensive income. Let's get to the statement of income. And so we can see here right away that Costco has a different revenue stream. Just membership fees. Walmart doesn't require membership fees. Let's see. Revenues. Oh, okay. So Walmart does have some memberships and other income, membership fees as well. So this is how they compare. Walmart has a lot more income, a lot more revenue than Costco, right? This is in millions. So this is $519 billion in revenue. It's an insane amount of money. And this is 149 billion. So how can we compare these two? They're similar, right? But how do we compare their profitability? We'll use their margin. This is called a margin analysis. And so what we talked about is, I want to use exactly here so you can see how we assess. How do we figure out their profit margin? What's their net income divided by net sales? Net income. Where's our net income? Other income. Net income attributable. That's what we'll call it here. Let's see. Net income attributable to Costco. Here, that's what we might care about. 3,659 divided by total revenue, 152,703. So Costco has a 2.4% profit margin. Did everyone see how we calculated that? We took 3.7 divided by the net sales, or the total revenue. 2.4% profit margin. Now, let's see how that compares to Walmart. Walmart, we have 14,881 net income attributable to Walmart divided by 519,926. 2.9%. Very similar profit margins, right? Very, very similar profit margins. And so that makes sense to us. So which one had a better profit margin? We know that Costco had a slightly better profit margin, 2.9%. That makes sense. Costco's a more of a premium brand, we'd say, than Walmart, right? So Walmart, let's see. Or it looks like Walmart might have had a better one. Let's see. 523,964. Yep. 2.9%. And so if I was Costco, who has a more premium brand, I would ask myself, and has charges a membership fee, what is causing our net income? What is causing our Costco's profitability to be less than Walmart? And then we can use that we can use those tools, right? The horizontal and vertical analyses in order to determine what's going wrong here. And so I would use a tool like it looks like we have operating, selling, and general administrative expense for Walmart as a percentage of their total sales. So we can say that divided by 523,964. 108,791 divided by 523,964 is about 20% of their cost goes into operating the stores. Let's see. Divided by 152,703. Only 10% goes into operating stores for Costco. So it's more expensive to operate the Walmart stores. So it must be coming from something else, right? And so we'll go 152,703. We're spending 90% or 87% on our cost of goods sold, merchandising cost or cost of goods sold, while Walmart is spending 75%. And so there we get our answer, right? We can see really quickly that one of the main reasons that Walmart is having a better profit margin is because they're able to better manage their cost of sales. And so if I was in Costco's management, one of my quickest questions would be, in order for us to improve our profitability, how do we make sure that we are getting a better deal on our sales as a part of revenue? Either we need to charge more for our products or we need to get better deals. And this makes sense because Walmart has always been known for significantly negotiating down costs with sources, while Costco has been more known for giving you the cost that they pay, right? And making more money off membership fees. So this is how we can see comparisons of businesses, right? This is the tools we're using. That was what we just used profit margin. Look how much we learned. I would be surprised. I didn't know this about Costco and Walmart. I wouldn't have never guessed that Walmart has a higher profit margin than Costco. But this is what we learned just from this class. So you can do this with any company, any investment. I use this to buy, not a lot, I'm not rich off this by any stretch, but I use these assessments back in 2010 to buy Walmart stock. And now, because I saw that Walmart was undervalued. And so you can use this, and now my Walmart stock has almost tripled in value from the original day. So you can use these tools to be able to see, wow, Walmart is doing very well. Maybe I want to invest in it, even though other companies seem to have a higher valuation or are getting cost more, valued at more. And so we'll do some comparisons too to how to make that investment decision called price earnings, which will be a lot of fun to go over. Gross margin or gross profit. This ratio measures the amount remaining from $1 in sales. So gross margin or gross profit. So this is slightly different than profit margin. What we're doing here is to determine how much we make per sale. So let's do this for, I'll go over the calculation very quickly with you. Are you all finding this interesting? I can go into it in more detail. I know we all want to get to the final. I think this is useful information. I want to make sure that, okay. Good. I want you to see how the whole picture comes together, right? And then the accounting, right? What makes accounting so amazing here is now you know how net sales are different than gross sales. Now you know how cost of sales are different than expenses. And if you didn't know that, you didn't know the fundamentals behind it, you're really never going to be any good at finance, right? And so that's where the whole picture comes together. And so I'm glad that you're seeing this whole class through. So net sales minus cost of sales. How's this different, right? Before we're looking at net income. Now we're looking at net sales minus cost of sales, which we know that's how we measure profit margin. So in this case, we're saying we had net sales of 494,000 minus 140,000. And we're going to take that over our net sales. We know that on average, we charge a 71% profit margin. We get a profit margin of 71%, probably on all our goods. That's the average, right? And so we can compare that for Costco, and we compare that for Walmart. Costco, we know our merchandise costs versus our total revenue. Probably it makes more sense just to look at net sales. Membership revenue doesn't really have much to do with it. We'll look at total for now. 152,703 minus 132,886. And then we divide that by our 152,703, our net sales. Costco has a 13% profit margin. That's what we're expecting, about 12.9% or 13%. But if we're looking at Walmart, how's their profit margin? So net sales, 523,464 minus cost of sales, 605, divided by 23964, 20, almost 25%. So on every sale, Costco's making, so every dollar that they sell, they're making about 25 cents of profit. So $1.25. Well, that for Walmart. While Costco's only making 19 cents. So Walmart's making significantly more on every sale. That's all profitability, right? Then there's operating expenses, which we haven't really, some other operating expenses or interest expenses, which we haven't really dove into, like non-operating expenses. But we don't need to really worry about that for now when it comes to profitability. We're just wondering from the core business model, can you make money? I think that I'm surprised 20% seems very high for something where Walmart can charge so cheap, right? So this is other examples. I'll let you go through them because the answers are here. I wanted to use real companies so you could be more interested in this. And then there's these other pieces where we can compare return on total assets. And so this tells us how good we can deduct it. And so that's the thing, is we can reduce either, right? And so for profitability, we're generally assuming that we can cut selling, general, and administrative costs. So if you're looking at layoffs in the job market right now, most layoffs are coming from these costs. These are things we can control. And so profitability, we're really looking at net sales minus merchandising. Everything else we can control. Merchandising costs or cost of goods sold or something that's very difficult to control. And so we are going to look at profitability. We can look at both, right? So we looked at one metric where we included it and one where we excluded it, right? So net income over net sales includes G&A, and then the gross margin excludes it. So we can see how much we can control if we take out the selling and administrative expense. Yeah, perfect. Great questions. Really, really smart questions. And so the last piece is we can say, how smart is a company being with its assets, right? That's useful to know too. You want to know if a company has, let's say, we'll say Costco has $45 billion in assets. 45 billion, that's huge. Well, how much money are they making with those assets? And so we can take what they're saying here is our net income divided by average total assets, right? Just showing you where it's all coming from. So what's our average total assets? Well, we just take these two and divide it by 2. So 45,400 plus 4830 divided by 2. So their average assets is, let's say, 43 billion. And then we just take our revenue. Where is that income statement? Our net income. So we'll take, I'll just round, right? 3,600 divided by 45 billion. We're getting about 8% return. So that means that if you're investing in Costco, you get about an 8% return. Every dollar that they invest in their assets, they buy a store, they're going to likely generate an 8% return from that dollar that they spent. Right? And so that seems pretty strong. That's better than they'd get by getting a lot of investments. So investing in themselves, they're able to get an 8% return. That seems like a strong return. Let's see how that compares then to Walmart. Walmart's assets, let's see, that starts with different pieces. Let's see. Walmart has total assets of, these numbers are so outrageous to me. 240 billion. 236,495 plus 219,295. We're divided by 2 to find our average. So let's say 228 billion total assets. Well, let's say let's figure out Walmart's net income. Net income. So we're going to say, let's say 15 billion divided by the 228 to round. 228. They get a lower return, right? So for their assets that they invest. So what is that telling us? It's telling us that Costco is doing better from asset management standpoint than Walmart. Walmart might be more profitable in their everyday daily business, but Walmart also has to spend more on assets in order to generate a lower income, a lower return based on their assets. And so that's interesting. So Walmart's model, it's a higher, more asset intensive. And if we go and think about how this makes sense for businesses, right? If I go into a Costco, there's kind of a premium, there's less of a premium experience there, right? It's really bare bones. There's no shelves. it's a warehouse that you go through that's just has standard lighting, right? But you go to a Walmart, generally it tries to be a nicer experience. The floors are a little nicer. You have TVs lining the stands. You have a lot more happening within a store, a lot more painting. It's a lot less bare bones. So it makes sense that they have to spend more on their assets to maintain their brand. So this is where we can learn about how a company's managing its assets. And then we can compare what's a better investment, right? So from that standpoint, like maybe Costco looks more attractive. But at the end of the day, right, and which we're going to talk about as a team, at the end is, well, what's the price for the investment? And that's something we're going to use called the price earnings ratio, which we're going to go over soon. So this is how I like to do something called value investing. And then return on common stockholders' equity. This measure, so this is very similar to return on assets, but then this is, as an investor, if I invest money, what's my average return? What's my return on common stockholders' equity? And so we could look at our net income minus preferred dividends, because remember, common shareholders don't have a right to dividends before preferred. Preferred always get their dividends first, and then we get divided by our average common stockholders' equity. And so that net income, we'll just use one example. Examples here. Net income again, 3.6. And instead of an average, just to speed up the class, because I can get too excited about this stuff. Total equity, I'm just going to take that total equity. 15,584. So Costco makes about a 24% return on equity invested. That's huge, right? So if you invest $1 in Costco, they make you a 24% return based on that dollar of equity you invested. Walmart, let's see how Walmart stands up. Walmart's income statement, we go to net income, 14,881 divided by, let's look at their equity. They still have sizable, right? You get about an 18% return, or 18 cents on every dollar you invest into Walmart goes back into their equity. Meaning equity is either going to be paying you in dividends, right? So Walmart will pay you dividends, or equity is going to be paying you out in equity will pay you out in their retained earnings, where they're going to keep reinvesting their money. And right, by reinvesting their money, they're going to be reinvesting in assets that generate more returns for your equity. And so here we see that Costco generally makes more money for its investors than Walmart, likely because Walmart has so many investors. So ways we can look at like basic earnings, there's other ways that we can look at how companies do related to investors. So if I want to buy their shares, right, if I want to be an investor, and we can look at basic earnings per share. Earnings per share is an extremely complicated metric. Don't want to go into it in significant detail. Memorize the formulas I provide here, but you'll learn more about earnings per share down the road. And I really want to talk about the price earnings ratio and dividend yields. And that'll end this class, and then we'll take a break, and then we'll go into our final discussion. So basic earnings per share, you're going to take net income divided by minus preferred dividends by the weighted average common shares outstanding. I know this sounds intense. This will be given to you. I'm not going to ask you to recalculate it. The idea here is throughout the year, common shares, the company issues goes up and down. So we're going to take in a weighted average by the amount of years. So the amount of issued through the year. So example, if we had 100,000 at the beginning of a year and then issued 10,000 in the middle of the year, that 10,000 would be weighted for half a year. So only 5,000 would be included in the total. Goal here really is to determine how much money is going to the common shareholders. Like how much money does each share generate? And so each company will just provide this information for you, and then the weighted average. So I don't want you to have to worry about that for your calculations, but just be aware of it. That's how the calculation occurs, and memorize that formula. And so every public company that trades has to present this number. And so we can see here, Costco's earnings per share is significantly higher than Walmart's, which is basic income per share attributable, 522 versus 832. But that doesn't tell us so much because the shares might be a lot more. And it looks like Walmart has a lot more shares, weighted average shares outstanding. Let's see. Is this in millions? Let's see, in millions. Except per share data. So it actually looks like Costco has a lot more shares outstanding than Walmart as well. Walmart has about 2 billion shares outstanding. Costco has 439. Oh, look, 2 million. I think that there must be a note related to this one. I'm guessing this is in billions. I'm guessing Walmart has larger shares than Costco. And this is probably in millions, and this is probably in billions. And so the idea here is, because Walmart has more shares outstanding, likely has more shares outstanding, the common shares attributable is going to be a little less than Costco, because they have to pay so many more shareholders out. And so we can see here that buying Costco, a share in Costco, might be more beneficial from a dollar value perspective than a share in Walmart. But then we have to ask ourselves, really, is Walmart a better, it doesn't matter how much money it generates. Oh, basic versus diluted. So no, that's a very complicated question, unfortunately. And it's just I worry it's gonna confuse everyone in the class. But there's options that companies might have, and diluted means that if a company was to sell all of its options, or if customers were to exercise those options, how many options outstanding how many shares outstanding, worst case scenario, how many shares outstanding would the company have? And then how would that affect earnings per share? And so if everyone today decided to exercise every option that was outstanding for Walmart, then there would be more shareholders, which would reduce the value per shareholder. That's the concept. We haven't gotten into a lot into stock options in this class. It's a very advanced accounting and finance topic. And so expect to learn that more in detail in the future. But great question. The idea is, think of that as a worst case scenario. That's very overly simplified, but worst case scenario, if everyone becomes an owner that could become an owner of the company, how low can it become? So awesome. So basic. So the basic here we're saying is, okay, so each share I get, each shareholder is making about $5.22. That's the way to think of it. If I own a share in Walmart, I'm getting about $5.22 this last year in returns. And that doesn't mean that I received a dividend for it or anything like that. It just means that's the appreciation generally on my shares or on the value of the company. From a company perspective, the value of the stock's different, right? The price that people are willing to pay for it. And then Costco, you're getting about $8. But at the end of the day, we need to know, do a new comparison. What's the stock price? Right, so it doesn't matter if I'm making $8 on a share if the share is 3 times the price. It's actually a better deal to get the Walmart shares, right? So we have something called price-earnings ratio. The price-earnings ratio is my favorite piece for valuing shares. And it's a way that we can make comparisons against companies. And so as a team, we just did a pretty full analysis on the profitability and assets of Walmart and Costco. If we really wanted to make the investment, we should read the whole financial statements and understand if there's anything else going on that's driving these valuations, right? And so we can look at the last 5 years stock price to kind of play around with this. But what this price earnings ratio will do is then take the price and compare it to how that earnings is, what we've discussed the earnings, in order to determine which is cheaper, right? So when comparing these two, I would say that's fair to say these are competitors, right? From my standpoint, I might go to Walmart, I might go to Costco. I might see them as competitors, right? That's perceived by the consumer. So my question is, what's cheaper to buy if I want to invest? And so what they're doing here is they're finding by the earnings per share or by the price, which is going to yield you, which is cheaper. And so here it's about $23.69. That's just the price of the current stock divided by the earnings. So 122.94, and we went to the Walmart's earnings here, divided by 8.32. It's 14 there. So their most recent quarterly must be different. So overall, though, that's how they're calculating. They're saying most recent earnings release, 23.69 cents for every dollar earned. But Costco, you have to spend $35.90. So this means that Costco is more expensive to invest in than Walmart by almost, we can do the comparison, 35.90 minus 23.69. $12.21. Or we can say from the base, 35.90. It's a 34% markup to buy Costco shares over Walmart shares. And so the question here is, why is that? Right? And if you want to become a solid investor, this is the basics of it, and I'm trying to get you all excited about financial analysis and accounting, is you can make money in the market if you know, if you determine, well, Walmart is going to do as well as Costco, or Costco is going to do, Costco and Walmart should be likely valued. So either Costco's value is going to go up or go down, or Walmart's value is going to go up. And so in this case, you could buy shares of Walmart or bet on the fact that Costco is going to go down in value. Yes, Sunil, that's exactly what it means. It means that more people are betting that Costco is going to do better than Walmart. But that's where you could that's where as an investor, you can see an opportunity. You could bet against that, right? You could say, this is kind of Warren Buffett's method. He'll look at the underlying companies and then note, well, I'm going to buy what's on discount. If I think that these companies are doing the same and then other investors are thinking the future of Costco is better, but to me, they both look the same by underlying investment, then I'm going to invest in a company that's a better value, buy it on discount. We can do the same, right, with anything. Apple stock, APL, versus, I think their most common is Microsoft. So we can look at their 5 years. Both have very similar patterns. But we can see right now, Apple is being traded at a much lower price earnings than Microsoft. Microsoft's come out with Teams and a lot of remote work environment recently. So in this case, if we were to say that these are equal competitors and both of them have the same outlook, Apple would be a better value stock than Microsoft. But we'd have to go through and do that full analysis that we just did, and then look through the notes and make sure there's no legal contingencies or nothing we're concerned about underlying. So does that make sense for the team? Are we all on the same page here? I want to show how we can use all of those tools to make investment decisions as business owners, assessing against competitors, or assessing as stock owners. The last piece is the dividend yield. This tells us, what do we have here, is how much for every dollar we invest in the company, how much we can expect to return. And so as a dividend, as a common share dividend. And so again, Apple and Microsoft pay about the same. The market's down right now, right? So dividend yields are expected to be lower. We can also look at we'll look at Walmart stock. Walmart commodities generally pay higher dividends versus Costco. Walmart pays a higher dividend, and then car companies and older companies generally pay much higher dividends. Dividend yield on GM is 6%, which means if you invest $1, you expect to get $6 a year. These are called dividend stocks, while you might look at Ford stock, which pays a much larger dividend of 11%, right? So these are ways to compare. Math is here. Annual cash dividends per share and the market price of the share at the time of dividend. Yeah. So now I want you to memorize all these ratios, and hopefully this will give you the fundamentals to eventually get into financial statement analysis. And so that's where it all comes together. And I wish I could teach everyone this as the first lecture, so it's probably the most exciting part of accounting. But you need to understand what a dividend is. You need to understand what equity is, and all the journal entries behind it before we can really understand what any of this means. So great job, everyone. That concludes our last lecture of the course. Really proud of everyone sticking it through 13 lectures, half of it remote through coronavirus times. Loved getting to know you all. Hope to see you in future classes. I'm going to take a break now. I'm really impressed with everyone. I'm going to take a break, and then we'll go over our final review. That piece won't be recorded. I just want it for anyone here who stuck it to the end and is taking their last Saturday. Before we go into, so I'm going to stop our recording now. We'll talk about final review a little bit, and then we're going to take our break. But I just want to thank everyone. This has been a great class, and I'll share this recording as our last lecture.